Okay, so let's look at this. Let's talk about the market crashes. So in 1987, there was a market crash called the Black Monday. So it happened in 19th October, and the Dow Jones fell, right? Fell by a lot. So I have a video to show you on a news reporter reporting about this. So I want you to hear this news, okay? Okay, I hope no advertisement.
From the Independent News, this is USA Tonight with Brad Holbrook.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points. The day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute. The panic starting in Tokyo this morning while the West slept. One cause of the sell-off was reaction to last week's 236-point drop in the Dow. The result, the Nikkei average was down 260 yen. Then, like a plague, sell fever headed west. In Frankfurt, fears of higher interest rates in the U.S. triggered the drop there. In 2.5 hours of trading, the Commerzbank share index fell 132 points. In London, an even larger drop. The British market, trying to cope with Friday's national computer failure, was thrown into a near panic. The result, the London Financial Times index down more than 183, the biggest one-day drop in Britain's history. And from there to Wall Street, where the numbers speak for themselves. Unofficially, the Dow stands at 1738.41, a drop of more than 508 points, with a volume of more than 604 million shares. Proof, as Alec Roberts reports, that the panic hit a fevered pitch.
From the opening bell, the market was in free fall. After last Friday's record 108-point loss, analysts had expected a rally. Instead,
it's a panic. Everyone's in panic. Everybody, we're trying to find a bottom. We're trying to, as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom. And then they trade 5 points lower than that.
By noon, the market was down about 150 points. The tape delayed by more than an hour. But it only got worse as trading brokers struggled to cope with a blizzard of sell orders.
New Mexico, we have some work here to do. You want to buy.
Since the market hit a high of 2,722 last August, it lost 17.5% of its value to 2246 by Friday, and another 508 points today.
More and more analysts believe that the bear market is here to stay. It's not that the economic news is so much worse. In fact, some indicators are showing unexpected strength. It's the psychology that's changed. While for 5 years investors have looked at the economy as a glass that is half full, now they're seeing it as half empty.
Reasons for the decline have been floating around for months. An accident waiting to happen, according to one analyst. Renewed inflation fears with a decline in the dollar, rising interest rates, and huge budget and foreign trade deficits, a nation living for too long beyond its means. The results of the decline will hit millions of people in their investments, pension plans, their mutual funds, and eventually every segment of the economy. Higher interest rates, for example, will hurt the housing market. Even normally optimistic analyst Larry Wachtel doesn't see a quick recovery.
What usually happens in cases like these where the psychology has been so scarred is that once there is a technical rally back in which people unload on the rally, then you go through a long quiet period. The people that got out don't want to get in. The people that wanted to get in aren't sure about whether they want to get in now. And so you go through a long quiet convalescence period.
President Reagan, however, was more optimistic.
Where our productivity is up, so is our manufacturing product up. There is no runaway inflation as there has been in the past. So, as I say, I don't think anyone should panic.
In New York, this is Alec Roberts reporting.
Oh, but panic they did. Joining us now is Stephen Malin, senior economist for the Conference Board, the country's largest business-sponsored research organization. Stephen, there is late word tonight. I don't want to spring this on you unawares that on the Tokyo Exchange, there's a little bit of a rebound, or actually they're calling it a strong rebound on the dollar. market there. Would that be an indicator that things here might sweeten up tomorrow?
Well, I don't know if that's a sign that things will sweeten up. It's a sign that I think that the people in Tokyo don't want to see any more pessimism in America. It's a mild sign of slight confidence, but it is not a sign of optimism at all.
What would it take to stem the losses here?
Well, tomorrow's indications would be that you would see a market which is much less violently up and down. If we see something which is down but not violently down, if we see volumes, trading volumes, which are not quite so large, I think we would see a sign that this is starting to stem.
In terms of 1929, which everyone's comparing this to as saying it was double that in terms of percentage of loss, there are a lot of other things that don't match up with 1929 in terms of the economy. How do you assess the effect this would have as opposed to the one in 1929?
Well, this is a very different economy in the sense that it's a lot stronger economy, and most of all, it is a global economy. The 1929 economy did not have the openness of our markets. We are much more now a trading economy, an economy that relies on those foreign markets. And the key foreign market, as we learned today, is the financial market, and that to me is the big, big difference.
Okay, now we have a lot of people that play with very big bucks in the financial markets. What about the rest of us who don't have more than a passing interest in the stock market? Should we be concerned or interested in what's going on?
Oh, you better believe it. Everything that happened today should shake us up. First of all, people who have mortgages have to be concerned about their interest rates. Now, the interesting thing is that we're not going to see a violent rise in interest rates associated with this, and that's a good sign. But we might see a mild movement upward, and that's fine. What we may also see, however, is that savings plans and people who are involved in those are going to get hit because a lot of those are involved with mutual funds, and people who are in mutual funds got hit hard very well today.
Now, what about looking at the blue chip stocks that everyone analyzes for mutual funds? They're very cheap tomorrow morning. Would you be interested in buying them this early?
No, I wouldn't touch anything yet. What we're going to have to do is look at what happens when we wake up in the morning tomorrow and see what happened in the Asian and European markets. What could very well happen is that we're going to see signs of more chaos, and if we do, then you want to stay out.
Stephen, do you see any winners in what happened today?
Well, I'd like to be a stockbroker cashing in on some of the commissions today.
Good point. A lot of activity there. Stephen Malin, thank you very much for being with us. Elsewhere, America's richest man, Sam Walton, who's chairman of Walmart Stores Incorporated, was unaware of the market plunge for most of the day today. And when he was told about it, Walton said he'll take care of his company and the market can take care of itself. Walton controls about 218 million shares of Walmart stock, which means he just lost about $1 billion today.
Okay, so I want you to listen to the talk. Okay, of course there's a reason why. So the possible reasons that was mentioned why there was a fall that Monday was reaction to previous market declines. Okay, so it has already happened before and it's continued to do so. So there's a continuation of the fall. Shifting investor psychology. So someone said that the investors are now looking, instead of looking half full, it's half empty sentiment. There was a fear of high interest rates, fear of renewed inflation, decline in dollar, budget and foreign trade deficit, and basically the panic is a global event starting from Tokyo. And as for Tokyo, why did Tokyo fall? According to sources, it started in Tokyo, but one of the causes was a reaction to the previous drop in the Dow. So Tokyo dropped because the Dow dropped. So Tokyo wasn't the first, okay, because Dow was already dropped. So I don't know who started first. Now I want you to show you all this is to demonstrate to you that the fears or the problem people face then is the same as today. It sounds the same, right? Interest rate, inflation, decline in dollar, trade deficit, sounds the same, right? So are we going to have a crisis? I tell you, every single year is the same. Every single year. But what is really different on normal times and crisis is sentiment, psychology. So one moment you have investors who are very bullish, so they push up the market price. The next moment they can become very pessimistic. That is different. But in terms of economic factors, right, it's always the same concern, inflation. That one is the same. That one is based on facts, so you can't change it. but the human psychology is the key, right? Yeah, humans are like that, okay? Now, more importantly, like what happens if you invest at the wrong time, and what happens if you invest perfectly at the perfect timing? So the graph here is the Dow. I plotted September until today. So, September over the next 3 years, September 1987 to 1989. So if you are invested at the peak, which is September, that's the worst time, right? Or if you invest at the bottom, that's the best time. So I want to see, like, okay, if you invest at the worst time or the best time, then if you hold until today, which is 30 over years, quite long, okay, then what is your return? Okay, you want to know what's the return? What's the difference? Return, you don't know what's the difference.
Difference.
Different. In terms of percentage, like let's say one is 5% per annum, the other one 10% per annum. So the 5 one is probably the worst. You bought at the peak lah. So I want to know the difference, like in terms of per annum, what is the difference in the return?
Less than 1%. Yeah, also
less
be very minor. Right?
Less than 1% different. You?
I think less than 5%.
Less than 5% different. So if you invest at the worst time, right, your return is 10.5% per annum. If you invest at the right time, right, it's 11.7. So it's the difference is really very small. It's how many? 1.2, right? 1.2%.
Everybody keep asking us to VC.
Yeah. So whether let's say you are really an unfortunate person, you dump in everything at the wrong time, right? Actually, if you have holding power, it's not an issue. It's not an issue, right? It's an issue if you have no holding power. Let's say you are only 2 years time horizon, 3 years time horizon, then your losses can be very good. Can be very big. See, like this, if you invest the wrong time, right, it plunged by 30%. It took about more than 2 years to break even. So if your time horizon is just say 1 year, right, you cash out, it's gone. So time is your friend. Okay, time can be your friend. And so this is one thing I want to point out to you.
The total return is
different. Yeah, because of power compounding, right? At 1.2%, power compounding, you give you different, quite a big end result. But this is to show that you won't die if you invest at the wrong time. It's still not bad, it's still quite good. Okay, let's talk about selling at the wrong time. Let's say you sell at the worst time during the GFC, global financial crisis in 2008. So it's about slightly more than 20 years after the Black Monday. So let's say you sell at March 2009 at the wrong time. Okay, you buy at the wrong time and you sell at the wrong time. Okay, you buy at the peak in 87 and you sell at the bottom of 2009. Actually, 2009 is the bottom. So what is your return like? What's the figure you can tell me? Is it 1% per annum? Is just break even only? Don't dare to give an answer.
No, I'm not sure.
No different. Absolute. How many percent per annum?
9.5.
9.5. Wow, very optimistic. You buy at the wrong time, you sell at the wrong time. Then you double what me, no?
I think should be a lot. I think negative.
Negative
30%.
87 to 2008 is more than 20 years.
Because every time S&P dropped, before it dropped, like 20%, the market was hot.
So you think it's negative return lah?
Yeah.
Okay. So the conclusion is 7.1% per annum. You buy at the wrong time, you sell at the wrong time, 7.1. You see the graph? You can see you really sell at the wrong time. 2008.
Still positive.
Still positive. Okay. Yeah. Still positive. This is 20 over years. Yeah. 22 years. Yeah. So it's not that long. I'm not asking you to do 40 years. No. It's 22 years. Okay. So all this to show you that not to worry if you buy the wrong time. But you can sell at the wrong time provided you already hold it for some time. Okay. Yeah. Okay, so I hope this will show. Now, does this apply to stocks? Yes and no. If the stock is, firstly, because it's an index, so index, right, the stock's always changing. Right? It's auto rebalancing, auto selection. But if it's stock, right, you start with one stock, right, the stock must survive during this period. So for stocks, right, you assume that you buy now and you hold for 30 years, right, or 20 years, you assume that it's still relevant 20 years later, which may or may not be true. So for stock, need to be careful. You don't go and buy and then hold forever. A lot of Singaporean investors, they buy and then they hold forever and then they, lemon, right? Become lemon. Because it may be a good stock today, good company, but it can be disrupted by something else. For ETF and unit trust, ETF, right, it's auto selection. Let's say it used to be maybe top stock in the S&P 500, for example, and top one. But because maybe one fine day it got disrupted, by maybe AI or IT or whatever, they got disrupted by another type of technology, right? Then the stock that was number one, right, the share price will fall, right? So it gets smaller and smaller until it gets kicked out of the index. And then the one that's doing better and better will go into the index. So for ETF or funds, right, it's auto selection. But not, if you hold individual stock, you must monitor. Okay, for stocks, no such thing as buy and hold forever. No such thing. Okay, you need to monitor. Okay, so this is a summary. Investing in the worst time and sell the worst time over 22 years still give you quite reasonable, 7%. Not bad, Still not bad. Okay, so the lesson is economic factors are always the same. The concern is always the same. Doesn't matter whether you invest at the worst timing or the best timing. The difference is not very noticeable if you are a long-term investor in indexing, indexing. And if you buy and sell wrong time, also not a big deal. But the psychology of the crowd can change overnight. That is the key, right? So right now, the stock market psychology is very bullish. People are very optimistic. I don't like when people are optimistic. Okay? I like when people are pessimistic. Then, you really can find very good stock to buy. Okay, now, so how do I know whether is it optimistic or pessimistic? There's this fear index. So I show you before I show you again. I like this fear index. I made a lot of money through this fear index. I made a lot of money for you all through this fear index. But just looking at this really can help. So there's this chart here that shows the sentiment. So now in the greedy phase. The extreme fear happened before, about 1.5 years ago. And it's people start to give up, start to be very pessimistic. This is the part to buy stocks. And they buy anything, I sure win one. Buy anything, seriously. But now here, so it's very hard to buy. But when it's here, it's really great Singapore sale. But most people, right, when it comes to extreme fear, right, they don't dare to buy a lot. They buy a bit, but not a lot. Maybe 5,000, 20,000. Frankly speaking, if when the time comes where I ask you to buy when extreme fear comes, and it's only 20,000, right, you forget it. No need to bother, because that 20,000, if it become 100% gain, right, the extra 20,000 is not going to do much for you. It's not going to help you to have early retirement, for example. Okay, so most people will hesitate, so they don't put a lot. Okay, so right now I give up waiting for the extreme fear and ask people to buy a lot, because I know a lot will not come. Okay, it will not come on. Try already. I tried for 20 years already. People will not invest a lot doing extreme fear. So the only way is just invest. Just invest in great companies, or dollar cost averaging also can, every month. Yeah. Okay, so this is about the education today. So okay, so I'm coming to the end. So this is the walk 24th September. If you're coming, please text me. If you have not told me, please text me. At least one day earlier, so I'll wait for you. Okay, this is a weekday though, but surprisingly, a lot of people sign up. Okay, so